Richard Clarida. He's Pimco's Global Strategic Advisor, also a former Assistant Treasury Secretary.
Glad to be here.
Thanks for coming in today. It seems like globally the consensus at this very moment seems to be that the recovery is slowing. What did you think from the Federal Reserve's decision yesterday?
Well, the recovery is slowing, and I think the Fed acknowledged that yesterday, took the markets a bit by surprise by moving some of those mortgage holdings into treasuries, and I think it was a signal that reaffirmed really the weak data we've been getting for several months now in the U.S.
So if it's just an affirmation of what was known, was the Fed basically saying, we got this in making that move and not going further, or is this a sign, as the markets seem to be reflecting this morning, that they might be seeing something more worrisome than we know about?
No, I think they're seeing what we're seeing, but what I think they indicated is they certainly left the door open at a future meeting to ease further. So they certainly didn't close the door and saying we're done on this. I think their mind is open, the data has weakened, and I think they could well ease further later this year.
So what does a $2 trillion target for the Fed portfolio do to support the recovery effort?
Well, what it does mean is the Fed's portfolio won't be shrinking, and as a result, they will be buying treasuries over the next year of about $300 billion more than they would have otherwise. Now, $300 billion is a big number. Total issuance will be about $1.8 trillion, but still, it's a big move compared to the alternative.
Yesterday, with the Fed's decision to go out and buy treasuries, some say that lessens volatility, that could be supportive of risk assets, but the risk trade seems to be very much off at this moment.
Yeah, well, absolutely. Rates will be lower, which would be supportive of risk, but it's a signal that the Fed is concerned. They've changed their language since the June meeting, and so I actually think that reinforced concern about robust growth going ahead.
Now, inflation, the language didn't change in the FOMC statement yesterday.
Right.
Should it have?
No, I think the language is appropriate. There's really no inflation in sight. One thing that the Fed is actually benefiting from is that inflation expectations are well anchored, and they're monitoring that closely. But no, the economy with very high unemployment, there really is no inflation on the radar.
Is it an overreaction to look at the industrial output numbers out of China today and the idea that the growth story there, it's still happening, but it's slowing, that there may not be the offset to a slowdown here, that the growth may not be coming out of Asia? Yeah,
probably to answer your question directly, it probably is an overreaction on any 1 month's data. You look for trends. I was in Asia in May, and they had a weak number in April, and people were concerned. So you have to look at some trends, but I think it does highlight a point that we've emphasized, which is namely the markets now will be keyed on every little kernel of data because there is so much uncertainty.
That's part of the new normal that you've highlighted. Yeah. Headline risk amplified, essentially.
Yes, absolutely.
Give me a sense of one of the most recent headlines we got within the past hour. We had a trader on from the oil pits who says, look at the gasoline inventories building right now. It's the summer driving season. He read that as a sign that consumers aren't driving. What are you seeing on the consumer front? Well,
you know, that's a great question because, in fact, the Commerce Department actually revised the data substantially for the U.S., and it now shows much less consumption and more saving over the past year. One of the mysteries of 2009 is how come households weren't saving more, and in fact, they were. We just weren't measuring it. And so if households save more, that means they're driving less. That means it's a drag on economic growth.